All right, it's been a little while since I'd made one of these videos, but I wanted to address a topic that is top of mind to many, and that is the current state and future outlook of the commercial real estate debt market, specifically for office buildings. And for that, I'm joined by Nate Brzozowski, who is a senior managing director at Savills and one of our firm's top financial consultants. Nate, I appreciate you being here. Thank you.
No, great to be here.
There's obviously been a tremendous amount of stress on commercial real estate assets as vacancy rates and the cost of borrowing remain high. You wrote a great piece a few weeks back on LinkedIn about how the rise in interest rates and cap rates are impacting building valuations, which is putting a major strain on banks, lenders, and landlords. In layman's terms, which you're very good at, can you summarize the current state of affairs and how it may compare to past economic and real estate downturns?
Sure. Yeah, I mean, you're referring to a piece I wrote a few weeks back in response to sustained kind of media coverage of this looming debt crisis for commercial real estate. And it's interesting because, debt crisis in real estate seem to be a cyclical thing, right? There seems to be one every market cycle. And it's basically, generally, it's structural, right? It's something that needs to happen at a certain point because valuations generally start to run away. Here we had the added issue of, a pandemic, an economic downturn, which caused, we were coming out of a very low interest rate environment. We have a ton of commercial mortgages coming due right now. The maturity of those notes, even though they were generated 9, coming up on 10 years ago, they just happen to be maturing in a very hostile environment. And it's leading to landlords to be squeezed. And they're getting squeezed from two different directions. Just like when you have your house and you have a mortgage on your house, if you were to buy a $100,000 home and borrow 80% against it and have an $80,000 loan, if you went to go refinance that loan and the house is now worth $80,000, you don't have any equity. And if you want to borrow against an $80,000 home, you're going to get $60,000. I mean, we're using round numbers here, but the issue is the office buildings now, because of a rise in cap rates, which rise, commensurate with the growth of interest rates on a federal level, asset values come down. So now all these landlords have to replace 70% mortgages on high values with 70% mortgages on low values. And that debt is more expensive. The interest rates are now anywhere from 200 to 350 basis points higher out of the gate. So you're getting less money and you're paying more for it. And in order to keep the building, you're going to have to put in some equity too. And now these landlords are trying to figure out, do we throw more good cash after bad just to keep a building? And that's really what's happening right now is folks have to deal with this repricing of real estate, and it's got to come out of their own pocket on the equity side to make the math work. And that's the challenge we're facing right now.
And a repricing exercise when lender and landlord confidence isn't at an all-time high, where people are actually challenging for the first time compared to past downturns, the actual utility and value of office space as this hybrid and remote work environment continues to remain prominent. So speaking of debt maturities, there's over $100 billion worth of just CMBS loans set to mature in the second half of 2023 and another $126 billion maturing in 2024, setting the stage for a potentially turbulent 18 months. Talk us through the process and the conversations that landlords are having with their lenders when there is a debt maturing in the near term. And what happens if the math simply doesn't check out? Nobody wants to take a loss, but landlords, as you said, aren't going to continue to throw good money after bad. The lenders have to protect themselves and their investments. They don't necessarily want these buildings back. So where is the middle ground?
Yeah, I mean, it's a great question. And that's the one that, all of our clients are asking right now too. Several times a day, we're having these discussions, advising them on their likely position of their landlord, what the debt at their specific building looks like, and what the landlord's paths forward could be. along with their exposure to any default or risk of landlord default. There's no, contrary to kind of, I guess, popular belief, there's no quick solution to help a landlord who's in trouble on a debt basis and has to refi a loan that's too large. There are several ways through it. Obviously, kind of the scary one that's made all the press is, defaulting, foreclosure, and basically the landlord loses the building to the bank. Now, there's another term that's been out there called, handing the keys back or giving back the keys. The vast majority of real estate, commercial real estate loans, like 99% of them are non-recourse loans. Now, that doesn't mean there's no recourse. It just means that recourse for the lender is limited to the actual real estate. They can't come after the other assets of the landlord. So basically, what a landlord can choose to do is, if they, are so inclined, they can say, you know what, I tried. I don't want to put more money into it. Loan is due. I'm sorry, Mr. Lender. Here are the keys back. See you later. And that's kind of like that's been what's gotten all of the attention lately, because for the first time ever, we're seeing, top tier public type REITs and large firms embracing that strategy. Now, real estate firms have always done that sort of thing, but it was always kind of not a mark of shame, but no one ever liked to be seen as, not executing a business plan. The game has totally changed here. I mean, for the first time, you have major players saying, we're going to underwrite it, and if it doesn't look good, we're just going to give it back. And it's a really unprecedented time, and we're going to see more of it. We're certainly going to see more of it.
Yeah, it feels like people are under a microscope more so now, and rightfully so, than they have in the past. And speaking of that, there's been a number of high-profile bank closures across the country. Regional and community banks have the largest exposure to commercial real estate loans. More than 70% of these loans are made by small and mid-sized banks. And in many cases, they're selling off their loans at a steep discount. And David Rubenstein of the Carlyle Group recently said that the biggest single investment that he knows of today is probably going to be commercial real estate debt in downtown office buildings, buying it from banks when the banks want to get it off their books. Who do you see stepping into the commercial real estate debt market, and what will be the impact on banks?
I mean, boy, that's like the question of the century. So, at the heart of that question are several other really important questions, like what is going to be the sustained go forward demand for office space? What's going to be the most feasible repurposing of office that maybe is obsolete or no longer viable? Are we going to see like special investment vehicles start to get set up by, private equity players, which usually is what happens in times of distress? You have, private money come in and fill the void where there's no liquidity. And they come in and they basically start to find ways to buy things very cheap. I mean, 20, 30 cents on the dollar if they can. And, it's not dissimilar to the way, private equity or a hedge fund might go after a company that's not performing and try to find a way to monetize its assets. These guys are going to come in and see, what they can try to do, whether they can save the office aspect of the project, if they're going to do some kind of conversion to, medical or retail or residential, what have you. But they're going to be like opportunity value add players by and large, because the folks who right now are holding that debt, like you said, the regional banks, I mean, 10, 15 years ago, it was CMBS largely. That is not as much the case right now. I mean, CMBS standards, even though they started to get really lax again, relatively, we're not at the level of where they are, or where they were, 07, 08. So those regional banks are basically going to have to come up with some creative extension measures if they want to not lose it all today, if they can afford to hang on to it. There's going to be a lot of kick the can stuff going on. You're not going to see folks coming in and being able to scoop up assets at a discount like immediately or in large quantity out of the gate. But I would have to say it's going to be like the private equity pool of value add opportunity fund people willing to execute on a vision for either repurposing the office or seeking to inject a new vitality into the office use sector of the economy.
Yeah. So we're seeing a flight to quality across most markets where tenants are gravitating towards the best buildings and prime locations as a key way to get employees back. But there's also a flight to capital where we're digging deep into landlords' financials to make sure that they have the ability to transact. What are some of the questions tenants should be asking landlords before they move into a building? Number one. And number two, what can tenants do who might be 5 years remaining on their lease that don't have the ability to relocate? What kind of recourse do they have, or what kind of options do they have if they're in a building where there might be financial stress with the lender and landlord?
Yes. So in the situation where you're evaluating a potential new location, or you're going to be relocating maybe into a building, table stakes right now is asking basically the landlord to, on a large enough transaction, certainly open up their books in the sense of, to a certain amount, there's a lot of publicly available information on debt. You can generally understand based on the structure of the landlord what their probably, their target yields are on their equity. And you can kind of back solve and get directionally close. But what you really need to do is like approach that landlord and really request that this become a partnership type negotiation, because it used to be on the other side of the ledger, the landlords would have the magnifying glass on the tenant and looking through their audited cash flows and statements to make sure that they could afford the rent. And now the tables have somewhat turned in the sense that large tenants are now going up to the landlord saying, are you going to be able to pay the mortgage, for the next 3, 4, 5 years if I sign a lease with you? So understanding that structure, getting information, requesting the information about the capital stack, the amount of debt they have, if there's existence of junior or mezzanine lenders, that's like table stakes right now. And then on top of that, making sure that you negotiate into your new lease, really strong, as strong as you can, subordination and non-disturbance clauses, rights to offset and self-perform, a lot of those things that will protect you in the same sort of instance where a building might just get sold to a new owner and you want to maintain your ability to occupy the space the way you want to occupy it with the services that you're paying to receive. So there's a lot that can be done there, but it's nuanced and you have to be aggressive sometimes to get it. On the side where you're a tenant in an existing building, that's a little more challenging. You're going to want to actually turn first to your own lease. You're going to want to see, do you have that SNDA language? Do you have the rights to offset? How are your potential renewal rights, restoration rights? How are those impacted? Do you have any outstanding tenant improvement dollars that you are on the clock to use? It's a big overlooked one. A lot of folks will say, well, I have another 2 years to spend that money that they promised me 2 years ago. And if there's a problem and the landlord defaults or something, you're last in line on the list of creditors. You might never see that money. So there's a lot of things. There's no blanket suggestions, but again, that SNDA, that right to offset, going back to the lease, looking at the debt, those are the bedrock right now of smart diligence on a tenant's part.
No, that's a great point. With not every landlord is willing to give tenants SNDAs, and those with SNDAs, especially if they have outstanding tenant improvement dollars or burn downs in their security deposit, you want to make sure that you have pre-foreclosure default language that protects you for a lot of this money that may be owed in the event of a foreclosure or some kind of situation where the landlord is in financial trouble. Well, look, this has been a lot of doom and gloom. I want to end on a positive note. Give me something to be optimistic about, both for owners and tenants, and kind of where do you see things shaking out in the near term and long term?
So, I understand. It is definitely, we've all been kind of dragging ourselves through the past few years, wondering when we're going to get some kind of clarity. I have always maintained, and I'm sure you know this, but I've always maintained that, there's just a value to working in person, and you're hearing more and more and more now. You're hearing, straight from the heads of the banks and even the tech companies. And I think that there's, human beings have worked the way we've worked for over a century in like the modern office, so to speak. And there's a reason for that. And I think that we're realizing that with time. And the data is now starting to trickle in to back that up. I mean, in the past few months, you've seen multiple studies done where you're starting to see like an attributed lack of productivity on full remote platforms that are between anywhere in 10 and 20%. Just that's what's on the table right there. And, if you're running a company, 10 to 20% loss on an asset is not sustainable. It's not a way to maximize returns. And you're starting to see that now with more and more calls back to the office. I am a believer that the pendulum will continue to kind of swing that way. And I think that that's going to allow us to stabilize much in the way after 2007, 2008, when, the word on everybody's mind was like the downsizing of the right sizing of the office. And we basically saw 100,000 square foot tenants become 70,000 square foot tenants across the board. But that free fall in the first few years after stopped and then started to build back up again. And we're kind of in that next phase of it. And to be honest, it's different. It's different because this is structural. This is a possible demand issue on the structural side. People questioning the actual validity of office work. So it's a little bit different, but I think the data's starting to come out. I think that you're starting to see more and more people actually see kind of the negatives. It was very easy to see the positives of working from home when everyone first started doing it, but you're starting to hear more and more, especially from the young folks coming into the workforce for the first time, not getting the mentorship, not getting the social life aspect out of it, feeling like they're being left behind for advancement and promotion. You're starting to see a lot of the isolation and the psychological effects and the strain that it can cause on family life. So all of these things, I think, will contribute to a demand for the office place, and that'll allow this all hopefully to stabilize.
Yeah, look, I think the days of being in or being required to come in Monday through Friday, 9 to 5 are behind us. But as you said, things are cyclical. And as the labor market continues to soften a bit, business owners will feel a little bit more emboldened to require their employees to come back. And from an ownership perspective, look, there's going to be a lot of pain, no doubt. But anytime there's disruption, it's an opportunity to rethink things, to rethink city landscapes and become more diverse in their offerings to the communities they serve. So, this is going to be the great reckoning, as you said, but I really appreciate it, Nate. It's always fun to connect with you and pick your brain. And this is clearly a fluid situation. So we'll see what the coming months and years have in store for us.
I mean, look, these are those times in cycles where, change, a little change is good. A lot of change violently, I guess, will have to be good because that's where we are now. But basically, I remember when I was a kid growing up at the beach, we lived near some pine barrens, and every 10 years, the pine barrens would burn down. There'd be a massive blaze. Every tree would burn down, all the scrub oaks and everything else would burn down. And you come to learn that is a necessary part of the cycle of the forest. Sure. You got to clear the forest and then a new forest grows. So it's kind of part of that regenerative process. I hope that, will cause this cycle to, we'll be talking about this another 10 years saying, wow, remember when? And, I think the pieces are there and it's going to be interesting to see how it plays out.
Well, we'll all be replaced by AI bots.
Yeah, probably.
Yeah. All right, buddy. I really appreciate it. Thanks again.
You got it. Thank you.